So welcome back. We're going to get started. So the next part of this program is we're going to turn to a closer examination of the Fed's operating framework and then financial regulations and how they affect the repo market and what role they played in the event, if any. So for the operating framework, we're going to start with that. We have two experts. I think many of you know them. Bill English, Yale University, and former Director of Monetary Affairs at the board, and he'll describe the ample reserve framework. Then we have Bill Nelson, now with the Bank Policy Institute, former Deputy Director of Monetary Affairs. And then after their presentations, we'll continue with discussion and take some questions. So let me turn to Bill.
Okay, thank you very much, Trish, and thanks to Hutchins for inviting me here today. What I'd like to do is talk about three things. I'm going to talk a little bit about policy implementation frameworks as background, talk a little bit about what did the Fed learn in September about reserves demand, and then talk about possible adjustments to the policy implementation framework in light of what the Fed learned. So going back to kind of the pre-crisis era, as many of you know, the Fed had a small balance sheet. It had a low level of reserves. The desk went in every day. It did operations to try to adjust the supply of reserves to intersect the demand curve for reserves at the desired federal funds rate. And that system worked fine. But as Trish noted, after the crisis, that system didn't work anymore. Basically, after QE, the level of reserves was too big. Those sorts of small daily interventions weren't really feasible. So when it came time to lift off, the Fed did a lot of thinking about how to implement monetary policy, and they decided to administer monetary policy with a system of administered rates. So the rate paid on reserves, the IOER rate, and the rate paid on a new overnight RRP facility that took funds from non-banks. At a fixed rate. And that system also proved effective. So when it came time to lift off, the Fed raised the IOER rate. Is that working? No. Raised the IOER rate, raised the overnight RRP rate, market rates moved up, and subsequently, as policy was tightened, those rates were moved further and further, and market rates moved up along with them. Then, of course, we got to balance sheet normalization in 2017, and no decision at that point had been made about what the policy implementation framework would be in the long run. The committee said, we'll learn and we'll make decisions later, which seemed fair enough. And it was only last winter that the committee announced that they were going to go with an abundant reserves framework for policy implementation. Abundant, but not too abundant. In some sense, they wanted to be at the smallest level of reserves. It was consistent with being kind of on the flat part of that demand curve for reserves. So they were going to operate with a larger system than prior to the crisis. How much larger, as Trish said earlier, they didn't know, and they were quite upfront that they weren't sure. And so they would allow reserves to run down slowly over time. And at some point, market signals would be such that they'd realize they were kind of getting to the point where they were getting to that curve in the demand curve for reserves, and then they'd stop running the balance sheet off. So that gets us to what happened in September. They were learning about reserves demand, and they were surprised. They learned that the demand for reserves was higher and less elastic than they thought. They'd done surveys, they'd talked to institutions, and they just found that in markets, the reserves demand steepened faster than they thought, and so money market rates rose unexpectedly, and in addition, repo demand was strong at the time, as Trish discussed. Banks didn't step in to provide repo financing, and so repo rates spiked quite a lot. So that's my story for what happened in September, and then the question is, okay, so what are you going to do about that? And one thing you could do is add more reserves. That's in some sense what the Fed has done. And a second is you could establish a standing RP facility. So let me take those in turn. So the Fed realized that it allowed reserves to fall to too low a level. So the immediate response was kind of short-run temporary reserves adding operations. The desk got to work. They added reserves, and that stabilized rates and got the situation into a manageable place. And then after some discussion, in the longer run, the committee decided they'd do permanent reserve adding operations. They'd go out and they would buy bills. The purchase of bills was, I think, clever communication, as I think Dan discussed. The purchases really weren't purchases like the asset purchases into the LSAPs. They weren't buying longer-term treasuries to push down term premia to provide more monetary accommodation. This was kind of old-fashioned in a way. It's just doing transactions to add reserves to make policy implementation work better, to work more efficiently. Just had to be much bigger because we now live in a world of kind of jumbo-sized reserves, and so the operations are larger. And that has worked, as Trish showed back at the beginning. Now, you could go even further. You could add reserves, much more reserves. You could move to Dan's really abundant reserve system if you wanted to. That's going to provide a cushion. That's going to help to smooth out the volatility in money markets. You could add reserves until you start getting significant usage of the overnight RRP facility, for example, which has been very, very small for some time. That would provide a cushion of funds that could then be allocated to the private repo markets if rates began to spike. But that would require a bigger role for the overnight RRP program and a bigger role for money market funds in implementing monetary policy. The committee, at least back in 2014, when they discussed these issues in some detail, just wasn't really comfortable with that. They thought that was too big a role for the Fed, too big a footprint. And so they were not inclined to do something like that. My guess is they still aren't inclined to do something like that. So what else could you do? You could do a standing RP facility. It'd be always on at a fixed rate. The hope would be that would lead to automatic increases in reserves. When market rates began to move up, more folks would come to this facility. They'd bring their treasuries, they'd get their cash, and that would put downward pressure again on money market rates. That could be an effective ceiling on money market rates. That would be helpful because we don't really have one of those these days. We used to have one. It was called the discount window. Unfortunately, the discount window is so stigmatized post-crisis, nobody wants to come to it. It just doesn't work very well. And so, in effect, a standing RP facility might be a stand-in for the discount window in providing a cap on market rates. But it would raise a number of questions for the Fed. Two kind of framing questions are, first, the issue of footprint. How big a role does the Fed want in the repo market? Again, back in 2014, they didn't want that big a role, and so they may still not want that big a role. The second question is effectiveness. How effective would this be? Would market participants want to use it? Would it too be stigmatized, like the discount window is? So these are tricky issues that you'd have to bear in mind as you think about the structural questions of how would you design a standing RP facility. So three questions there. One is who can participate, presumably the primary dealers. They're the counterparties for OMO, open market operations. Second, I think probably banks, at least healthy banks, of course. Again, that would help cap the funds rate. It also, as Falato and IRIG have emphasized, could help encourage banks to shrink their reserves holdings. That would lead to a smaller Fed balance sheet. People probably would like that on the whole. Do you want to let others into the program? I think probably not, if you can avoid it, because then that gets the Fed into a much bigger role in the repo market, doing repo with hedge funds or whoever, and my guess is they wouldn't be comfortable with that. A second issue is what is the collateral? Probably just treasuries. I think you want it as boring as possible, as plain vanilla as possible. Maybe in a time of market stress, you could move to a single tranche program. You could allow agency debt and agency MBS, for example, as collateral. That would provide some flexibility in times of stress. That might be helpful. But in normal times, I think just treasuries. Maybe the hardest question is at what rate do you want to do this? Higher rates would, of course, encourage more market intervention. It would reduce footprint. It would avoid moral hazard. You wouldn't end up with a large group of smaller, perhaps weaker banks borrowing regularly from the Fed through the RP facility, which you might be pretty uncomfortable about. On the other hand, a lower rate would encourage participation. It would limit stigma. It would make it clear this isn't a penalty rate. This is just something we want you to use. It would limit volatility. Now, as Dan says, I'm not sure how much volatility you want, but it would make the program presumably more effective. So there are, I think, just some hard decisions to be made. I don't expect an answer from the Fed soon on this. I think they'll want to see how the planned purchases of bills and how the bigger balance sheet work, and maybe get through year end and see how things go, and allow firms to learn and to adjust to. Everybody's learning and adjusting in some sense. But if they're still, after that, is an amount of market volatility they're uncomfortable with, it certainly is a program that they could engage in. Thanks very much.
I'll do it. Oh, I already got that. Mike. Thank you. So thank you, Nellie, and Hutchins Center for the invitation to be here. So I'm going to take a look, to some extent, sort of the other side of that, but not completely. So I pretty much agree with everything that Bill just said, actually, which is perhaps not surprising since we worked side by side for 21 years. But there are two critical points on which we may disagree. First, what the Fed bumped into in mid-September is the short run, not the long run demand for reserves. In the long run, the steep part of the demand for reserves is much lower. Second, the cost of the large balance sheet implementation framework the Fed has adopted increases with the size of the balance sheet necessary to operate it. In my remarks, I will address these 2 points and describe the course the Fed could follow to reduce the level of reserves considerably, and I will argue that doing so is in the interests of the Federal Reserve and the economy. Now, the quantity of reserves that the Fed has judged to be necessary for reserves to be abundant has grown remarkably over time. In April 2008, when the Federal Reserve staff first considered the possibility of operating policy with an abundant reserves framework, staff estimated that the level of reserves that would be needed might be beyond the order of $35 billion, but could be larger on some days. The assumption rose to $100 billion in 2016, $500 billion in 2017, $600 billion, and $600 billion in 2018. Now, it's not possible to know precisely what level the FOMC judged necessary at the beginning of this year when it made its decision to adopt a large balance sheet framework, because the Fed decided to break with its own tradition and not disclose its forecast. However, available information suggests that at that time, the FOMC judged about $1 trillion in reserves was abundant. I'd guess that their current estimate is about $1.5 trillion. Now, why has the Fed's forecast of the minimum abundant level of reserves grown steadily over time? When the Fed completed QE3, reserves peaked at $2.8 trillion, and for nearly a decade, the interest rate on the Fed paid on reserve balances was above the interest rate banks could earn on other similar liquid assets. Over time, banks and their supervisors took actions that made sense in that environment, and they then became accustomed to the resulting important role of reserves in banks' liquidity management. A banker recently provided me an example of this process. When the interest rate on reserves was higher than market rates, her bank elected to hold reserves in an amount equal to its projected cash needs under stress over 1 week, and Treasury securities to cover needs over the following 3 weeks. When the repo rates moved higher than the interest rate on reserves, the bank considered reducing its cash holdings to its projected need over 3 days, still holding Treasury securities to cover the rest of the month. While both arrangements are consistent with liquidity requirements, supervisors would expect an explanation for the reduction in cash, an experience the banker's management decided they would rather avoid, and the bank elected not to make the change. In short, the Fed's estimate of the amount of reserves needed to operate a large balance sheet implementation framework has grown over time because the level needed has risen with the level provided. Now, such a dynamic led the Norges Bank, the Central Bank of Norway, in 2010 to switch from a system with abundant reserves to a system with more scarce reserves, which is roughly the reverse of the FOMC's decision in January. When seeking comment on their decision, they indicated, when Norges Bank keeps reserves relatively high for a period, it appears that banks gradually adjust to this level. With ever-increasing reserves in the banking system, there is a risk that Norges Bank assumes functions that should be left to the market. It is not Norges Bank's role to provide funding for banks. If a bank has a deficit of reserves, towards the end of the day, banks must be able to deal with this by trading in the interbank market. The dynamic can also be seen in a graph of the Fed funds IOER spread versus the level of excess reserves. The purple line shows the relationship as the Fed increased the level of reserves, and the orange line shows the relationship as reserves declined in recent years. As can be seen, the interest rate response as reserves has declined has been sharper, suggesting that banks and their supervisors grew accustomed to reserves as a source of liquidity, and it has taken higher spreads to move them off their preferred arrangements than it did to make them willing to hold the reserves in the first place. The dependence of the demand for reserves on supervisory preferences should not have taken the Fed by surprise. In late 2015, I informed the board members and the LISIC, the committee that oversees the supervision of the largest institutions, which I was on, that the FOMC would not be able to shrink reserve balances any lower than the level bank supervisors were encouraging banks to hold. In May 2018, I asked Vice Chair Quarles at a conference if supervisors were telling banks that they have to meet a material part of their high-quality liquid asset requirements with reserves, pointing out that, if so, the FOMC would not be able to get its balance sheet much smaller. The Vice Chair answered, I do know that that message has been communicated, at least in some supervisory circumstances, in the past. I would say that that's in the process of being rethought. Now, while it's true that the Fed's two recent senior financial officer surveys did not find that supervisory expectations, guidance, or regulations were important determinants of banks' demand for reserves, that's probably because the Fed did not include those possible reasons as potential responses to its questions on the surveys. Now, in response to a BPI survey conducted in January, many banks judged that supervision and regulation were important, or very important, as reasons for their bank's reserve demand, including Reg YY liquidity monitoring, the LCR, examiner expectations about the composition of liquidity buffers, and resolution liquidity requirements. Now, banks' elevated demand for reserves also reportedly stems from an unwillingness to risk running a daylight overdraft in their accounts at the Fed. Bankers have explained to me that, while a daylight overdraft used to be unremarkable, now, because overdrafts are rare, supervisors want an explanation if one occurs. Now, there is almost a religious disagreement over whether it is costly for the Fed to operate with a large balance sheet. For my part, here are the reasons why I judge that a large balance sheet is costly for the Fed. First, it costs taxpayers money. Term premiums are negative and have been for years. Moreover, the short rates used to calculate those term premiums have been below the IOER rate when the balance sheet is especially large. For both reasons, going forward, every dollar the Fed invests above and beyond the amount of currency reduces expected Fed income over the term of the securities. That's what a negative term premium means. Using conventional estimates, $1.5 trillion in reserves cost the Fed, and therefore taxpayers, about $15 billion a year in seigniorage. Second, it reduces the ability of the Fed to conduct QE. The FOMC perceived its ability to expand the balance sheet to be limited because of political considerations. If the Fed starts with a big portfolio, it will have less far to go. Now, while the Fed could engage in another maturity extension program if it held short-dated securities, but some estimates indicate that the MEP was less effective than the other LSAPs. Third, it puts Fed independence at risk. A large balance sheet means large interest payments to large domestic and foreign banks. Eventually, those payments will serve as fodder for those who would attack the Fed. Moreover, a large balance sheet will prove irresistible to Congress as a way to pay for things. For example, consider the financing plank of the Green New Deal. As checks go out, the government's bank, the Federal Reserve, clears the payments by crediting the seller's bank account with digital dollars. In other words, Congress can pass any budget it chooses, and our government already pays for everything by creating new money. But as Dave Lindsay would often remind us when we were drafting the Blue Book, they don't care what we think. The minutes of the November 2018 FOMC meetings explain what they think. So sorry about the long quote, but potential drawbacks of an abundant reserve regime include the need to maintain relatively sizable quantities of reserves and holdings of securities, and relatively large ongoing interest expenses associated with the remuneration of reserves. But FOMC participants thought that reserve supply could be reduced substantially below its current level while remaining in such a regime. Participants judged that if the level of reserves needed for a regime with abundant excess reserves turned out to be considerably higher than anticipated, the possibility of returning to a regime in which excess reserves were limited and adjustments in reserve supply were used to influence money market rates could warrant further consideration. Now, even though the Fed's estimate of the quantity of reserves necessary to implement the large balance sheet approach has probably been increased by at least half over the past year, the FOMC does not appear to be giving a small balance sheet approach further consideration. In fact, 2 weeks ago, the president of the New York Fed said, "I don't see any real need to seriously reconsider this. The fact that reserve levels are higher than perhaps we were anticipating a year or so ago doesn't fundamentally change this calculus, that this is a very effective and efficient way to run monetary policy." Now, if the Fed can get much smaller, and it is costly to be bigger, it follows that the Fed should take steps to shrink. To get much smaller, the Fed needs to take 3 steps. First, the Fed needs to control volatility in reserve balance, including especially those caused by swings in the Treasury General Account and to a lesser extent, the foreign repo pool. Now, a little background is in order. In 2008, the Fed allowed the Treasury to switch from keeping most of its cash at commercial banks to keeping all of its cash at the Fed. The Treasury initially increased its deposits to help the Fed finance its emergency lending, but the Treasury ended up keeping all of its cash at the Fed because doing so saved taxpayers' money when interest rates were near zero. Whereas before the crisis, the Treasury kept about $5 billion at the Fed, the Treasury's deposit is currently about $300 billion and highly variable. Another Fed liability that has increased significantly over time is the foreign repo pool, where foreign official and international holders of accounts at the Fed invest in overnight reverse repurchase agreements. That pool has grown from about $30 billion before the crisis to about $300 billion now. The growth owes in part to the New York Fed's removal of constraints on customers' ability to vary the size of their investments. When the Treasury General Account and the foreign repo pool vary, there is a corresponding equal and opposite change in reserve balances. The Fed can control variability in reserves using repos in the near term, but in the intermediate term, Treasury needs to return to keeping its cash in the private sector, and the Fed needs to reimpose constraints on the foreign repo pool. Now, second, the Fed needs to conduct a re-education campaign for bankers and bank supervisors to root out any unwarranted bias towards deposits at the Fed as a liquid asset and to reinstall the view that collateralized daylight overdrafts are unremarkable and appropriate. Then third, the Fed should then restart the gradual decline in the system's portfolio of securities. The resulting upward pressure on short-term interest rates relative to the IOER rate will lead banks to economize on their holding of reserve balances. Now, these steps will promote a virtuous cycle. Reduced volatility in reserves will allow the Fed to shrink with less risk of turmoil in money markets. Greater willingness to allow banks to substitute treasuries for reserve balances for purposes of meeting liquidity requirements will allow the Fed to shrink further and also reduce the risk of market volatility. And then the increased opportunity costs of keeping deposits at the Fed will lead banks to find alternatives and supervisors to eventually become more comfortable with those alternatives. Thank you.
So thank you both for those very interesting presentations. I'm going to start with a couple questions just to try to highlight some of the distinctions among the frameworks that you are both talking about. And so let me first start with Bill English. You don't actually seem to be that worried about September's market volatility. And is that right? And then why?
So, did that work? Okay, thank you. So I think you're basically right, and I think there are three reasons. One important one, of course, is it's not my livelihood. So not my
That
income,
was not what I was trying to.
not my bonus that's on the line if financing is expensive for a few days. But leaving that aside, I think the key question here is, do you have a monetary implementation framework that actually allows you to implement monetary policy? And I think they do. They have a system that works. The system with abundant reserves is effective. They can, by moving their administered rates, get rates to come out where they want them to come out. And at least if they leave some additional reserves, as they are now doing, that system is pretty effective, and the volatility in that system seems pretty low. So I think the third piece of why I'm reasonably comfortable is that the desk is much more active. The committee seems comfortable with the desk being more active, taking steps to reduce volatility and kind of ensure they end up with rates trading in the range where they want them to trade. So those things together, I think, make me more relaxed perhaps about the September events than a lot of people are. I do take Trish's comment earlier seriously, that this could nonetheless be kind of an indicator of an underlying problem that you need to worry about liquidity and resiliency. So it's worth holding conferences like this and thinking about these things. But am I really worried? Not really, no.
Okay. And Bill, I'll let you have an opportunity at that question.
Oh, I would just echo the last part of what Bill said. So in terms of implementing monetary policy, well, it does seem like they're now in a regime where they both have a giant balance sheet and they're actively intervening, which doesn't seem to be providing the benefits hoped for. But more seriously, I'm more worried about the fact that this happened in a very benign situation in terms of concerns about other credit quality, and I think it could well be an indicator that there's a more structural problem that could be much worse in a time when this financial system is weaker.
Okay. So one question I want to get to is something about something called a financial footprint, which the Fed's footprint in the financial markets, which is sort of used in different ways. And I think there's this general view of it's good for the Fed's footprint in the market to not be too big. Now, I think that means different things to different people. So I'm kind of curious, in both frameworks, I think both of you would say that your framework, one with a smaller balance sheet, one with ample reserves or abundant reserves, both have smaller financial footprints. So could you just sort of, talk about what you mean by financial footprint and how your framework means the Fed has a less imprint in the market? So, Bill, you want to start with that?
We're
Both
both Bill.
Bill. This was a standard problem all through for the last 20 years.
But sure, I'll start. So the question of footprint arose in a big way in 2014 as the committee was thinking about their policy implementation framework that they wanted to move toward over the longer run. And I guess I took it to mean that the policymakers didn't want to operate in great size, at least, in markets or with counterparties that weren't the traditional markets and counterparties in which it operated. And so it came up in particular in 2014 around the overnight RRP program and their desire that that program be small and that they not end up doing operations with money market funds in size every day, but rather most of their operations being with banks through the payment of interest on reserves. So I think an ample reserve system of the sort that they've outlined with kind of a lowish level of ample reserves means that the overnight RRP program is small. They're not having to do a whole lot of RPs. Once they finish buying the bills, I think they're hoping that they won't have to do a lot of RPs.
Hope is not a strategy.
It is a strategy. Sometimes it's all you got, and mostly the Fed will just be operating through the banking system in kind of a way that they're comfortable with. So that's the idea. Whether in fact as Bill and I were just joking about. I mean, whether they can get to a size that actually allows them to not have to be doing operations in a fairly high-frequency way is unclear. They may have to operate with a somewhat bigger balance sheet than they wanted, but I think they can find a size that works if they want to do that.
Yeah, and Bill, you talk about shrinking the balance sheet and, implementing monetary policy. How does that work to keep the footprint out?
So to put my cards on the table,
Yeah.
I'm actually one of the few people who really thinks the Fed should go back to conducting policy the way it did before the crisis. Now, before the crisis, the Fed conducted small operations with broker-dealers in the repo market. The broker-dealers were not dependent upon those operations. The rate that they cleared at, the Fed didn't care about, and it used those operations to manipulate the supply of reserves in the federal funds market. It cared about the federal funds market, but it wasn't actually operating in that market. So it had very good control of supply and demand in a relatively small market that it wasn't operating in, and that rate was well transmitted into the rest of the economy. Now, and just to sort of see how different things are now, if you add up, and this is kind of not good economics, but if you add up the assets and liabilities from the Fed's balance sheet pre-crisis that were with entities other than the U.S. government and currency, so all foreign entities, private entities, pre-crisis that number was $66 billion, and it represented 4% of the sum of assets and liabilities. Right now, that number is $1.99 trillion. So it's $2 trillion, and it's about 25% of the Fed's balance sheet. So, I mean, I think that, the Fed is on a path of being much more involved in being part of the financial system. It has, and I think that the really scary prospect is if the Fed takes the step to decide that it needs to control the repo rate, or if it even says, well, we're going to control a range of rates, and that includes the repo rate, then it's going to have to try to control a $1 trillion market instead of a relatively small market in which it does not control supply or demand, and then it's going to have to do it with its standing overnight RRP facility and potentially a standing RP facility, be on both sides of that market, and it's going to take very large transactions to do it, and it's effectively going to be the clearer of that market at first resort.
And can you just, has the Fed entertained the idea of changing the target rate, or are you just?
Oh, no, yes,
throwing
absolutely
this
has. It's
out?
come
Yeah.
up over the time in FOMC meetings, and it's sort of often been mentioned favorably by the
Yeah.
New York Fed. And I know Joe and Brian, for example, on a piece recently, Brian Sack, who was former desk operator, called for the Fed to target the repo rate.
Right. I mean, I have just one more question, then we'll turn to the audience. So there's been a fair amount of confusion about intraday liquidity. And Bill Nelson, you raised the idea of daylight overdrafts. And could you just expand on that? And there seems to be some reserves, the need for reserves to meet intraday payments, and so some demand for reserves coming from that, but also the ability to use daylight overdrafts. Can you just talk about that a little bit?
Yeah, happy to. So BPI, we've actually had 3 symposiums now on the growing pressure in reserve markets that became apparent about a year or so ago. And in the second one, actually, which was 4 or 5 months ago, bankers said the biggest determinant of their cash needs is actually their intraday needs. And I wish I'd paid more attention to that then, because that story became a big part of it. And that was mentioned prominently in the Fed in response to the Fed's Senior Financial Officer Service, because that was one of the reasons they did give the banks. Large banks experience a significant flow in their cash holdings over the course of the day. Payments go out at the beginning of the day. That runs down their reserves, and then they come back in at the end of the day. Now, if you go back pre-crisis, banks would typically run a daylight overdraft. The Fed wanted them to run daylight overdrafts. It was how the system worked. And in 2011, the Fed changed its payment system risk policy to establish collateralized daylight overdrafts specifically to sort of promote that operation. During the day, their accounts run negative, and then they come back positive, and that's all collateralized.
Right.
But those overdrafts have become so rare because there's so much cash, the reserves are so high, that people didn't run daylight overdrafts. And now, if you run a daylight overdraft, it's actually something fairly extraordinary, and your supervisor is going to want to know, well, why did you run a daylight overdraft? Now, I've also heard from various sources that that you are not allowed to anticipate running a daylight overdraft in your Title I resolution plans. And that's contributed to the view among bankers that, well, we really shouldn't run daylight overdrafts. Now, in terms of the repo volatility, late in the day, late in the morning, once the pressure started to materialize, that was when banks were at their low ebb of cash, and they weren't willing to just redeploy it and risk running a daylight overdraft.
Let me turn to the audience for questions. There are some microphones. Please say your name. We'll start with Joe. Can you stand up and the microphone will come to you? And yeah.
Thank you, Neil. Joe Gagnon, Peterson Institute for International Economics, and a former colleague of all three of you. So my question's for Bill English, but I think Bill Nelson will probably want to chime in too. So you gave a good explanation of how the committee is thinking about these issues, including the standing RP facility, which is the other thing that Brian Sack and I recently wrote about. So just to put, we favor that. But you didn't really, I didn't get a good sense of how you feel about it yourself. You more characterized how the committee's thinking. So I'd like to hear, and in particular, the previous panel, people talk about moral hazard, and if we had this facility permanently out there, would that cause banks to be overly not sufficiently concerned about managing their liquidity. But I guess my question is, well, if moral hazard is usually a concern if it leads to a harmful catastrophe like your house burning down, and that's bad for everyone. In this case, if it leads to banks turning to the Fed for funding at no cost to the taxpayer, because these are I'm referring to only funding government guaranteed securities. So with a reasonable haircut and a surcharge, whatever the spread would be, the Fed would, if anything, make money. There's almost no risk of loss. So what's the harm in telling banks and regulators they don't need to spend a lot of valuable resources worrying about that risk when it's a risk the Fed can easily offset, and forcing banks to worry about the other risks and financing the rest of their portfolios?
Okay. Thank you. Other questions right now?
Hi, Gina Smilik, New York Times. Bill English, this is also a question for you, and kind of along the same lines. But you mentioned this idea that the Fed has noted in the minutes and elsewhere that, like the discount window, there's a chance that a standing repo facility would face a stigma. And I'm just curious what your view is on that. Do you think it's likely that there would be a stigma, and how important is where that rate is set to whether that stigma exists?
Want to take those questions right now? What do you
Sure.
think of a standing repo facility?
So I'm going to give a couple of answers, but then I'm going to pass to Bill, because he actually has a nice paper on do we need liquidity regulation and lender of last resort, which I think gets at Joe's point, right? It's if you can do this for free, why not do it? Why do we make banks hold lots of costly liquidity? So that's up your alley, I think. So do I think an RP facility is a good idea? Basically, yes, I do. I think one for broker-dealer, primary dealers and banks would be very helpful. I worry that the discount window doesn't work. We need to have some sort of safety valve for money markets, and that safety valve could be an RP facility, and so I think that would be helpful. I think the questions that I listed earlier are real, and the hardest one for me is the rate. So what is the rate that you want? So what am I worried about? I guess I would worry a bit that if I said we're going to have an RP facility, it's going to be open to all DIs, and you set a rate such that 1,000 DIs were using it every day, because for them it was not a rate that was unattractive. It was a rate that was attractive. They're small. They're in markets where deposit markets aren't that great, and they're paying higher rates. And so for them, this is a great marginal cost of funds. I guess I'd worry about that. I'd worry that's causing distortions. But so that's why I wouldn't want to set a really low RP rate. But how high, I think, is hard, and this gets to your question. I think if it's too high, it will look like a penalty rate, and it will look like this isn't something you're supposed to do. You're only using it because you screwed up, and then there are problems, and your name will be published, in 2 years under the new rules. So I think it's just hard to say. I mean, currently the discount rate is 50 basis points above the top of the Fed funds target. So lower than that, because as Joe said, this is really safe, good collateral. How much lower, I don't really know. I'd have to think hard and get more information than I have about kind of how much take-up do you think you would get as you move that rate down. I think that would be the question for me.
And I also wrote something more recently.
Please, yeah.
Well, you were right on that. I also wrote something more recently on challenges with the standing repo facility. But just to follow up a little bit and amplify what Bill said, in 2003, the Federal Reserve went from a below market rate using a facility called adjustment credit to an above market rate, something called primary credit. That was intended, primary credit, adjustment credit was a facility with a lot of rules and a lot of stigma, and the objective was to go to primary credit, which had no rules. It was going to be a rate-ration thing alone with a fairly strict credit quality requirement to reduce stigma, to make it simple. And it took about, it took from 1999 or so to 2003 to really get it done. And because of what Bill's describing, it was very difficult to come up with a system that you could just sort of let it operate by itself, and yet people would choose to use it only when there was pressure and not use it too much. And those terms had to work for what are, I think there's about 10,000 depository institutions out there when you count all the little credit unions that can all borrow from the Fed. And you don't need thousands of them to want to borrow all the time to have a problem. You just need 5 or 6 of them to want to borrow all the time to have a crop problem. The Fed doesn't want to be the Federal Home Loan Banks. So I think it could be I think it could be a real challenge to stand such a facility up. You could open it for just the primary dealers, but I'm not sure how helpful that would be. But to get to the deeper question of moral hazard, I tend to agree that the moral hazard associated with a facility that converts treasuries for cash would be pretty de minimis. Because really, I mean, moral hazard, in my view, is mostly a problem when there's a question about the solvency of the institution or maybe the quality of the collateral. And I don't think that would be the case in either circumstance. Yeah.
Thank you. Any other questions right now? Please. And be brief, please. You let us your name and a brief question, please, and we get a couple more. Before.
Sure,
Thank you.
Josh Younger. I guess one of the themes that's emerging is there's plenty of cash. It's just not where it needs to be, when it needs to be. And we haven't really talked about the federal funds market very much, and that's supposed to be the solution. Like distributional issues are supposed to be resolved through that market. So I guess the fact that Fed effective volumes went down on the 17th of September, and it's turned into this very bilateral market, FHLB's lending and so forth, like keeping it brief, I guess. But like the fact that Fed funds doesn't trade, are you concerned about that? And if we wanted to trade, how do we incentivize that in this current environment?
I saw a couple others right there. Stand up, George. Here we go.
Yeah, George Selgin from Cato. Some other countries, of course, have similar facilities to the standing repo facility and seem to manage corridor systems using them. Why should it be more of a problem for us? What's different about us? That's for both speakers, of course.
Mm-hmm. And one, can you stand up? And yes, Micah. Yeah.
Thank you, Micah Green with Steptoe & Johnson. Picking up on your point about primary dealers or beyond primary dealers, if the collateral is Treasury, what we heard in the previous panel is that there does seem to be some concentration risk in the marketplace and there's not enough breadth of demand. There may be plenty of cash, but it may be concentrated in too few entities. What would be the problem with having a facility, if it was based on Treasuries, with having a broader set of access to it to broaden out the market demand?
Do you want to start. We have a few questions about
Yep.
Fed funds market, trading.
So,
standing
so
for
I'll
peak
take a stab
facility.
at these, but then
Yeah.
Bill can clean up after me, as he did for so long. So, so the first question was, gee, there's a lot of reserves out there, but they're not where they're supposed to be. Why aren't we seeing more Fed funds trades? I don't know, in some sense, exactly why. I think partly it's because, as Bill was describing earlier, the demand for reserves by some firms is really strong. They don't want to trade Fed funds much. They don't want to be providing Fed funds. So I guess the question is, as we were discussing over lunch, there's a high level of reserves, but is it really high relative to what people really want to have for these various regulatory reasons? Repo facilities have been used, different central banks use different ways of implementing monetary policy. You certainly could implement monetary policy using a repo facility and an RP facility very much along the lines that Joe and co-author have discussed. So that certainly is a possibility. I think the FOMC in the past has just been concerned about dominating that market. And it requires large operations and operations with a lot of firms, and that just is something they've not wanted to do as part of their implementation process. And I'm sorry, the third question was
The concentration of primary dealers, and is that affecting the way arbitrage or willingness to make markets?
I guess I don't feel like I have enough knowledge about those markets to answer that.
Go ahead, Bill.
Okay,
Clean up.
and also
Clean
like my
up.
career, I've always
And
been
also quickly.
one step behind you, and you also give all the good answers first. So I think the big surprise about the Fed funds market is not how small it is, but the fact that it exists at all. I mean, since the QEs, there really shouldn't be a Fed funds market. I mean, so for a long time it was FBOs borrowing from GSEs who don't get interest on reserve, and it was the FBOs because they don't pay FDIC premiums, so they were the marginal borrower. And now, as you point out, it's FHLBs trading with larger institutions that it's an LCR play. It reduces their LCR to do that. It's effectively like, you know, the Fed could have paid interest on reserves to banks with odd ABA numbers and not the ones with even ABA numbers, and then switch it in order to have a Fed funds market. But the way to get the Fed funds market back is to continue to shrink until you get enough separation between market rates and IOER that banks will want to economize on their holding. And so at the end of the day, if they have extra reserves, they'll trade around with that. Now, that's going to, you know, well, to get more detail would take a very long answer, I think. But another question was, why not open why not open a standing repo facility for more institutions? And I think the answer there really is it would just really scare the bejesus out of people. So the people that you would want to open it to that wouldn't have access because they're banks or branches or primary dealers would to a large extent be hedge funds who are big borrowers in the repo market. And the Fed's been saying, look, this is nothing like 2008, and they're right. And they have the authority under Section 14 to do open market operations with anyone against against Treasury agency collateral. So they could open it up for hedge funds. But I think that honestly, if they did, people would really say, well, wow, I think that something's really, really, really going bad out there. Now, there was one more question about
Concentration? Which we could also.
No, what was
Okay.
the other question about? Okay. Oh, well, what's that? No, that was the one I just
That is
answered.
the one, which we can take into the next session, because we have enough
Okay.
people on
What's
that
that?
topic.
Oh, that's
Other
right. So
countries, yeah.
when designing the primary dealer facility, I was actually on the team that interviewed other countries to talk about why didn't the Bundesbank experience stigma with their I forget what it's called now, their facility, their above market facility. And then that was sort of what the ECB adopted. And what I was told by the person who ran the facility was, because to be clear, the Fed has had stigma problems probably since its inception, at least for 50 years. It is not a new thing. And his point was, don't have all these rules. Don't, and sort of don't make it common. That was his view. I think it also has to do with the fact that the Fed has always used one facility to be both its monetary policy facility, putting a ceiling on rate, and also its first go-to facility when there's an emergency. So when you combine those things, it looks like something's gone wrong if you're using your backup liquidity source. But
That's perfect. Okay, so join me, thank you, this panel. Very nice to have speakers.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.